If you run a small or mid-sized business, you probably felt this tension. You've got momentum, maybe even strong demand, but growth needs cash. Not just for the big, exciting stuff like opening a new location or launching a product, but for the unglamorous things too, like payroll, inventory, equipment repairs, and covering the gap between sending an invoice and getting paid. Today, we're going to map out the practical ways businesses fund growth and stay stable. I like to group it into 4 buckets: grow it internally, rent it, buy it, or blend it. In other words, use profits, use debt, use equity, or use a hybrid like mezzanine financing. And we'll talk about the trade-offs, because there's no free money. Every option has a price. You just pay it in different ways.
And if you're listening thinking, I just need a simple answer, we'll still help. The goal is to get you to a clearer decision framework: what you're funding, how fast you need it, how predictable your cash flow is, and what you're willing to give up to get the capital.
Let's start with the first bucket: grow it internally. That means funding growth from your own profits and from improvements on your balance sheet.
People sometimes roll their eyes at this because it sounds slow, but it's powerful. If you can finance growth from operations, you keep control. No lender covenants, no investor expectations, no dilution.
Exactly. Internally funded growth is about generating cash and freeing up cash. Generating cash is obvious. Increase revenue, improve margins, and manage pricing. Freeing up cash is where a lot of owners find surprises. Tightening collections, reducing inventory that's just sitting, negotiating better payment terms with suppliers, and watching recurring expenses.
One question I like to ask is, where is your cash trapped? Is it trapped in accounts receivable because customers pay in 60 days? Is it trapped on shelves as inventory? Is it trapped in equipment you bought when demand was higher?
And the process here is pretty straightforward, even if it's not always easy. You set targets for profitability and cash flow. You track key drivers weekly or monthly, and you build a habit of reinvesting intentionally. The upside is control and lower risk. The downside is speed. If an opportunity is time-sensitive, profits alone might not get you there quickly enough.
Also, growth can actually strain cash. You can be profitable on paper and still run short because you're buying inventory and paying labor before the money comes in.
Which brings us to bucket 2, rent it. Debt financing. You're essentially renting someone else's money for a period of time and paying interest for the privilege.
Debt is often the first external capital option businesses consider because you don't give up ownership. But lenders care deeply about repayment. They want to see cash flow, collateral, and confidence that you can pay them back on schedule.
Debt usually shows up in a few common forms. One is working capital solutions. Think lines of credit that help you manage the timing gap between expenses and customer payments. Another is asset-based solutions, equipment loans, vehicle financing, or loans tied to specific assets.
A working capital line can be a lifesaver if you have seasonal swings or you're scaling. But it can also become a crutch if the business model is fundamentally cash negative.
Right. Here's a practical way to think about debt. It's best for predictable situations. If you have reasonably stable cash flow and you can forecast repayment, debt can amplify growth. If cash flow is volatile, debt can turn stress into panic really fast.
And there are trade-offs. With debt, you're taking on fixed obligations. Sometimes there are covenants, meaning the lender requires you to maintain certain financial ratios or limits what you can do, like taking on more debt or making large distributions.
Let's talk about the process for debt. A lender will typically want clean financial statements, recent tax returns, a clear picture of your cash flow, and details on what you're using the funds for. You'll usually need a story that makes sense: what the capital does, how it creates value, and how the payback works.
And a tip: don't wait until you're desperate. The best time to secure a line of credit is when you don't urgently need it. When you're already in a cash crunch, your negotiating power drops and options shrink.
All right, bucket 3, buy it, equity financing. Instead of renting money and paying interest, you're exchanging a piece of ownership for capital.
Equity is often misunderstood. People hear investment and think it's just cash for growth. But equity investors are buying a claim on future value. They want returns, and usually that means the business needs to scale, increase profitability, and eventually create an exit or liquidity event.
Equity can come from a range of sources. Early on, you might see angels, which are individuals investing their own money. Then there's venture capital, usually looking for high-growth, scalable businesses. Family offices can be flexible, often investing patient capital on behalf of a family's wealth. Private equity is common for established businesses with consistent earnings and clear operational improvement opportunities. And strategic partners might invest because your business helps theirs, like a supplier, distributor, or industry player.
The upside of equity is that it can be more forgiving on cash flow in the short term. There's no required monthly principal payment like a loan. It can also bring expertise, relationships, recruiting power, and credibility.
The downside is you're sharing the future. That can mean dilution, loss of control, and decision-making that becomes more complex. An investor may want a board seat, reporting, and influence over strategy, hiring, budgets, and timing.
So the real question is, are you building a business you want to fully control, or are you building a business you want to scale with partners and potentially sell or recapitalize later?
Let's make the equity process feel less mysterious. Investors typically want to see a strong narrative and evidence. They'll look at your market, your competitive edge, your unit economics, your team, and how the capital changes its trajectory. They'll ask, if we put in this amount, what happens in 12, 24, 36 months?
And be ready for diligence. That's the deep review, financials, contracts, customer concentration, legal issues, IP, employee matters, and operational risk. It can be intense, and it can take time.
Now, bucket 4, blend it. Hybrid financing, including something many owners hear about but don't fully understand: mezzanine financing.
Think of mezzanine as sitting between senior debt and pure equity. It often behaves like debt with higher interest, but it may include equity-like features, like warrants or the ability to convert to equity under certain conditions.
Mezzanine can be useful when a business is too advanced for typical venture, but still wants to avoid giving up as much ownership as a full equity round might require. Or when the company can support more capital than a bank will lend, but it's not ready to sell a big chunk of equity.
The trade-off is cost and complexity. Mezzanine capital is usually more expensive than bank debt because it's taking more risk, and the legal structure can be more involved.
Hybrids can also mean something simpler. Maybe you use profits for steady reinvestment, a line of credit for working capital swings, and a targeted equipment loan for a specific asset. Not every blend needs to be fancy.
So how do you choose? I think you start with what you're funding. Is it short-term working capital? That points you toward a line of credit or receivables-focused solutions. Is it a long-lived asset like equipment? That points toward asset financing. Is it a major expansion, acquisition, or entering a new market? That's when equity or a structured hybrid might make sense.
Next, look at your cash flow reliability. The more predictable your cash flow, the more safely you can rent capital through debt. The less predictable it is, the more careful you must be about fixed repayments. Equity may fit better, even though it comes with share control.
Then consider your timeline and appetite for dilution. If you need capital quickly and have strong records, debt can be faster. Equity can take longer, but it may unlock bigger checks and strategic help. And if you're allergic to giving up ownership, then you'll naturally lean toward internal growth and debt, assuming the business can support it.
Let's also talk about a common pitfall: matching the wrong capital to the wrong need. Using long-term equity to plug a short-term cash leak is expensive. Using short-term debt to fund a long-term, uncertain bet can be dangerous.
Here's another pitfall: raising money without a clear plan for how it creates value. Capital doesn't fix operations. If margins are thin, collections are messy, and forecasting is guesswork, money can disappear faster than you expect.
So if someone listening wants a practical next step checklist, I'd say start here. First, define the use of funds in one sentence. Second, build a simple cash flow forecast that shows timing, not just profit. Third, decide what you can reasonably repay monthly without stressing the business. Fourth, decide how much ownership you're willing to share, if any. And fifth, prepare your materials. Clean financials, a clear narrative, and documentation ready for diligence.
And one more: Talk to multiple sources. Even if you think you want debt, talk to equity folks. If you think you want equity, talk to lenders. You learn the language, you learn what your business looks like through their lens, and you usually end up negotiating a better deal.
To wrap it up, there are really only a few ways to fund a growing business. You can grow it internally using profits and smart balance sheet management. You can rent capital with debt using working capital tools and asset financing. You can buy capital by trading equity for investment from angels, venture firms, family offices, private equity, or strategic partners. Or you can blend approaches with hybrids like mezzanine financing or a practical mix of tools.
And the best option is the one that matches your business reality, your cash flow, your growth plan, and what you want the business to be in 5 or 10 years.
Next time you hear someone say, just raise money, you'll know the better question is, what kind of money, for what purpose, at what cost, and with what strings attached?